Welcome to the Capital Gains Tax Solutions podcast, where we believe most high net worth individuals and those who help them, they struggle with clarifying their capital gains tax deferral options. Not having a clear plan is the enemy, and using a proven tax deferral strategy such as the Deferred Sales Trust is the best way for you to exit your highly appreciated real estate, cryptocurrency, primary home, or even commercial real estate syndication, all tax deferred. I'm your host, Brett Swarts. In each episode, I'm joined by some of the best real estate, financial wealth, and sometimes crypto minds in the world, where they share their ideas, deal stories, and inspiration. So together we can make complex tax deferral strategies simple and passive income plans achievable. I'm excited about our next guest. He's a repeat guest. He's an expert when it comes to commercial real estate syndication, as well an expert, and we'll let him define his crypto experience. But we're going to be talking all things deferred sales trust, cryptocurrency, and investment real estate, and just kind of dissecting what this can and cannot do for you. Please welcome to the show with me, Hunter Thompson. Hunter, how you doing?
I'm doing well. And I'll just provide some context. I know you're probably going to do this as well, but I kind of reached out to you, said, hey, we have to have a call on this because it's starting to click for me. I am going to ask you a bunch of questions, and I'm just going to be myself. For those that don't know me, I am kind of the capital raising guy. I've written a book called Raising Capital for Real Estate. It hit #1 on Amazon. I've raised $50 million from accredited investors, not institutions or family offices, but hundreds of people all over the country. We do this in an automated manner. We have a webinar about it. If you're interested in checking it out, you can go to raisingcapitalforrealestate.com/never-scramble. And that's all I want to do. That's all the talking I want to do. Now I'm just going to ask the man about this cool tool. And one more little piece of the intro. What I said offline, which is really important, is that in the world of finance in particular, anytime there's like a new tool, it's mostly not real. It's usually not, right? So if someone says, hey, we got this new insurance product that's going to save you all this money, and you got to do this and this and this. You give me a bunch of money and later you make money. No. It's usually not right, because it's all the tools have basically been uncovered at this stage of the game. We have a very mature market. We all have access to podcasts, blah, blah, blah. However, this is one of the few tools that, as I'm starting to learn more about this, I'm recognizing this is a completely blue ocean, a very immature space. And it's so good that a lot of people like myself that are fairly knowledgeable about these topics go, this is probably not real or not legal or hasn't been really put through the court system. All of that is not true. Now, that's the last thing I'm going to say. Now I'm going to ask you a bunch of questions because I'm interested in the topic.
Perfect, Hunter. Let's go. Ready?
Okay. So, and this is going to be very casual. I'm not going to be in my Hunter speaking mode like I typically am, but, so I'll tell you a quick crypto story, which is kind of very limited. I did what most people do when they have crypto in 2017, kind of lose your account. You forget your passwords. You have to go back and reset them, et cetera, et cetera. Anyway, long story short, this is probably the most irresponsible thing I've ever said publicly. I ended up finding a Bitcoin. I found a Bitcoin in an account. Now, in all fairness, the time I forgot about the Bitcoin, it was like worth $3,000. And I was just like, I'll move on with my life. Maybe it'll come back later. I forgot that it existed. And I recently logged in and found a Bitcoin. So that's not the reason I actually ended up reaching out to you, but it triggered something because so many people are going through something similar where the crypto thing has come back with such vengeance, and they're trying to figure out, oh my gosh, it made sense for me to have 3% of my portfolio in crypto. And now it's like 100% or 98% or whatever. And I need to do some diversification. So I have a similar situation in a startup, and maybe two startups, where I invested, a relatively small amount of money in terms of real estate investments, but it's probably going to be somewhere at 10x and a 20x. And now it's like really consequential. And so the reason I reached out to you is it's similar to what most people are going through with crypto, where I need to figure out a way to turn that into cash flow assets, et cetera. So that's my situation. By the way, that one of the companies is Thrive Market. I invested with them before they had a website, and now they're like $1 billion company. Wow. So anyway, it's a great company, but so that's the situation.
Excellent. And by the way, my goal too, to have this kind of open discussion with Hunter, just so you know, this is, we want transparency as much as you can, and we really want to help you kind of demystify kind of everything Hunter said about the legality, the background, what it is, what it's not, like, and literally just have a conversation. And so with Hunter's approval, he said, yeah, let's do it, because there's so many folks out there, whether you're a CPA, whether you're a commercial real estate syndicator operator, cryptocurrency investor, luxury realtor, like, you're very skeptical, and you should be, like Hunter said, because most new things or things that you hear for the first time are too good to be true, right? But we're going to talk about the track record. We're going to answer his questions and continue to show you with evidence what we've closed. And so with that being said, passing it back to Hunter. Hunter, what is your first question or thought or topic you want to dive into?
Okay. So my understanding is that I can create a trust, transfer the assets to the trust, functionally sell the assets, even though I'm not, I guess, technically doing the one selling it. You have a trustee managing that. As long as you don't receive the gains personally, you can keep the assets in the trust. First of all, is that a fair summary? Maybe some of the nuances.
Exactly.
Okay.
You actually nailed it on the head, but let me just do some clarifying pieces in between there, right? So what you're doing is you're lending the funds to the trust, and so we're actually doing a cryptocurrency deal right now.
Okay.
The gentleman bought Ethereum for 100,000. It's worth about 12 million. We're gonna take the first 5 million, and he's gonna transfer it from his Kraken account to the newly formed trust account. But he's not going to exchange it. He's not going to have that other account pay him anything. In fact, it's going to be just a direct transfer, kind of like if you were to transfer funds to a qualified intermediary if you're doing a 1031 exchange. Kind of like that. Kind of like if you were to put funds into an IRA. Kind of like if you put funds into a 401k. The difference here is it's not a continuity structure where you're selling something and moving it to another thing you're owning. It's an exit plan where you're literally exiting your position in exchange for a promissory note and becoming the lender. So in this scenario, he'll be owed back the 5 million plus a rate of return, but he hasn't received any of the 5 million, right? So therefore it's in a deferral state, kind of like an IRA, kind of like a 401k, kind of like a 1031.
Okay. I actually did not know that. So that makes sense. So basically you're transferring the assets to the trust, but the more appropriate way to say that is that you're lending the assets to the trust. Is that fair?
Exactly.
Okay. And the trust can pay you back. And when you do receive those payments, you are going to be taxed at capital, or I guess income level at that point.
Or tax deferral, not tax avoidance, right? This is very important. This is why the IRS looks at this. It's IRC 453 based upon 90-year-old tax law, which is an installment sale. So you're saying, look, IRS, I owe tax liability on that $5 million, right? Let's say in this scenario, it's 2. I know I owe that to you. And the government says, yes, thank you, Hunter, for showing that you owe that to us. But as you receive payments, if it's interest payments, you'll pay ordinary income tax on those interest of the 5 million. Right. If you dip into principal, you'll pay capital gains tax. But here's the kicker: that 2 million that you owe the government, it's at a 0 interest rate. So the question is, when would you like to pay 0% interest back to the government? The answer is, I'll answer for you, never, right? You want to keep that in a deferral state. Now, you eventually will pay it, and you'll pay the ordinary income tax. So it's not like we're never going to pay tax. It's just like a 401k or 1031 or an IRA. When do you pay tax on that? Well, when do you start receiving payments? Well, when do you start receiving payments? And this is the key. When does it work for you? A lot of our clients will delay for a couple of years, especially if their income's high. And in the meantime, they can use the funds. They can go back into active or passive real estate deals or stocks, bonds, and mutual funds. Or hard money lending, right? We can diversify the equity into multiple things. So it's perfect for the cryptocurrency person, right? Who's hit the home run lottery on the Ethereum or whatever, right? To sell, diversify, and then get some cash flow going. Okay.
So in my situation, selling the interest in the startup, which I'll probably likely do for both of them at some point, I would likely want to then take those proceeds and invest them in either both assets that I own directly, like securities or syndications in which I'm a GP owner, or passive syndications.
Yes.
And both of those are appropriate so far.
Absolutely. As long as it fits your risk tolerance questionnaire. So let's talk about the mathematical aspect of this. Before the funds go anywhere, Hunter, you would fill out a risk tolerance questionnaire. This is no wrong answers. This is a 2-page questionnaire. What's your level of risk tolerance? What's your level of experience with different investments? What are your income needs? Well, how soon could you need or want all the money? All of those things. Now that a score is determined based upon how you answer mathematically, and then an interest rate is assigned. Okay. Typically about 8% compounding net of all recurring fees over a 10-year period of time. That's where most of our clients hit. And at this point, you can be completely passive and just say, hey, someone else go do this for me. Whether that be another commercial real estate operator, stocks, bonds, mutual funds, right? But in your scenario, you're like, no, I like to be active and make a lot of wealth, and I know how to do that. That's why I do what I do, right? Up to 80%. So on the 5 million, about 4 million the next day could go into an LLC and could invest alongside of you, into your fund, your real estate fund, or your next real estate deal, right?
Okay.
As just an interest, an LP with you in that deal, right? As a silent investor. And this is the way we structure this. So, you, Hunter, form an LLC, which you're the managing member of, and you're looking for a partner. You're looking around and you find this trust over here that $4 million silently goes into that. And this LLC structured is 80-20 to set up, 80% to Hunter, even though Hunter puts up a 0 down payment. The trust puts up 100% of the down payment,
Okay.
$4 million, in exchange for 20% interest and an 8% pref. Okay. Now realize we got to pay the trust back, which is like a circle, which turns around and pays you anyways that 8%, right? So it's kind of like borrowing from yourself, but you're not borrowing from yourself, because if you were borrowing from yourself, it'd be taxable, Hunter. So we got to follow the guidelines and the rules. So it's literally a JV, joint partnership LLC. Now, once it's there in that LLC, can you put it into your fund? Yes. Can you put it into your own other deals? Yeah, just like you would on any other deal, right? You have LLCs that invest into your fund, or LLCs that invest into your syndications, right? So that's how that works. No, so why 80-20? Well, we need some liquidity. Okay, so what does the other $1 million go? Well, the other $1 million needs to stay liquid. Where's that? It's the biggest companies in the world, S&P 500.
Okay.
You have to improve those investments. Those are managed by a third-party financial advisor. He's my business partner, co-founder, who started this all. Okay, he would manage the funds there, again, based upon your risk tolerance, based upon your approval. Okay, so we're all working as a team here, and we're trying to diversify. Now, do we want to put all 80% into something that's really, really highly risky? Maybe, maybe not, right? Depending on your risk tolerance. But we might put 30% in a very, very high risk stuff, and another 20% in stuff that's bread and butter for what you've always done. So we're gonna massage and look at that and come to an assessment based upon your risk tolerance. So it's not unilateral control, but it's dual control, meaning you have to approve the investments. But if the risk tolerance is off and it's too risky for the trust, as the trustee, by the way, that's my role. We got to say, well, Hunter, remember your risk tolerance questionnaire. So we got to have some checks and balances here. That's important to understand. Whereas if you're a complete owner of all this, right, you don't have to answer to anybody. In this scenario, you do have to answer to the trust documents and the promissory note and the risk tolerance questionnaire.
Which to a large degree you create. I mean you. I mean the person that's involved in this transaction, the person, me in this case, I would
design it with you, exactly, alongside of you, exactly.
Okay. And then in terms of transacting, I mean, the thing that came to mind and why I wanted to reach out with you is I'm a little surprised that this is not done. Perhaps it is, but not talked about more, is like, why aren't, like, say, hedge funds doing this? Because that's what they're always trying to do. Like active traders, for example, my understanding with what you just outlined would be that you could then constantly actively trade without incurring any tax whatsoever on a year basis. Like you could defer a tax, but you could create a fund and basically trade in and out with whatever you wanted to do, and then always defer. Are they doing that, or why would that be prohibited?
Good question. So let's talk about the transaction minimums and the actual team it takes to execute this. So first of all, our minimum deal size is 1 million net proceeds and at least a $1 million gain.
Okay.
And we found that because the tax has to be big enough in order to pay off our fees. Okay.
Yeah.
First thing. So we typically, like I had a guy call me today and he's like, hey, oh yes, I have 30 LP positions and they're all collectively worth 4 million. I'm like, that's not a deal for us. Like you should go into an opportunity zone, right? Because it's brain surgery to sometimes with that many deals all at once to do this. Now, if you had 4 deals worth 4 million, that's great. We can sell each particular deal, crypto, business, commercial real estate, LP position, GP position, and roll it into one trust. That's fine. But we have to execute this because you're literally creating a transaction. It's not like just setting up an LLC and just transferring it. Like it takes the legal work, it takes the legal setup, it takes individual trust. So that hopefully is a part of the answer. The second part of the answer is short-term versus long-term, right? So if they're doing like day trading, right, these are typically short-term, right?
Yes.
Well, although we do have a solution for that. I'm working with another guy. He's actually out of Texas. He's bought and sold like 4,000 houses and a lot of small deals. And he said, well, can I just keep selling all? And we're like, well, what's the size of your deal? Oh, average one's $150,000. Okay, well, that's not great either because our transaction cost, it's always this high. So it's a give and take. Now I said, if you pull all those houses together and sell it to one big buyer for 15 or 20 million bucks, hey, that works, right? Because the transaction meets the tax liability and the deal. So that's kind of the answer. Hopefully that answers the question, Hunter, or more questions on that?
No, I understand. There's basically some stipulations around number one, the frequency of the trades. Number two, the volume of the dollars that we're talking about to make them make
Correct.
sense from a fee-based standpoint. And the
Exactly.
other
Although
thing,
we can do short term, just so you know, we do have a structure where we can actually do short term, but it needs to be
okay,
a very big deal and it moves it outside the taxable estate and it has a little more less flexibility. So just keep that in mind. But we typically save that for 2, 3, 4, 5, $10 million deals or
okay,
greater. But it does work for short term. But most of our deals are going to be 5 million and below using the traditional deferred sales trust based upon the client's needs and wants. So
okay. And the other really important metrics there is that this starts to make sense, at least from your business plan, like your company, et cetera. When someone has $1 million of gains, they're trying to defer.
per transaction. Now, if they have two at 500, it's good, but it
Okay.
also tends to make sense for you as well. It's got to be a win-win for all parties. We found when we've done some smaller deals, and the pain is like I did a deal. It was like a $700,000 deal, but the pain was only like 110. Like it wasn't that pain.
That's what the cane.
That's what the liability was. That's what the
Okay.
different than the gain, right? Liability is determined at basically 30 to 50%. And if Biden passes the proposal, it's going to be 50
Exactly.
to 70%, right?
Yeah.
So at the time, hers is like 110, and she's been a client, and I call that like a base hit. Like it's a solid base hit. It's not really a double or triple or home run. And I just found that when we're interacting, like the pain's not big enough for this particular client to like warrant like, well, what are the fees? And the fees are about 1.5% to set up, at 1.5% ongoing. And like it's just like what are you providing for me if the pain's not big? Now, if the pain is 3, 4, 500,000 of liability, wow, they're like, hey, home run, thank you guys. You guys are only charging 1.5%. Fantastic, if that makes sense.
Yeah. So it's crazy because another reason that you're getting so much attention right now, which is very well deserved, if you're listening to this or watching this, you've been doing a very good job of bringing this to light. And from a marketing standpoint, I don't really know many people that are just being like, I'm going to be the deferred sales trust guy. And that's just a very good position. In my intro, I said, I'm the raising capital guy. Right. And now we're best friends. We're not competitors, but there's just a complete opportunity for us to do it anyway. So,
Yep.
that's awesome.
Thanks. Thank you, sir.
So, let's think about this. So the $1 million gain thing is definitely important. Would that be, let's say I had a stock portfolio that had like 30 stocks. Cumulatively, there was like $1 million of exposure. Can you tie that up into one transaction?
No, same thing, right? So we
Okay.
can do publicly or private stock, but like
Okay.
give you an example though. This is really cool. We're working with a startup gal who started like 3 years ago with the company, and the stock went from $2 a share to $250 a share. Okay, and she has about $5 million of publicly traded stock, and we're gonna help her defer it. And she never has to work again, right? Which is part of the passion of what we want to do here. What Hunter and I and other commercial syndicators is we're creating opportunities for people to get passive and to have time, energy, freedom, right? Not have to work the corporate jobs. So that's the transformation. All of these are different tools. Real estate investing, right? Deferred sales trust is the tax part that kind of helps you to can get there, all tax deferred. But the key is the freedom that it provides in transformation for clients and for individuals and families. So it's a little plug there. But yeah, public stock. But again, got to be at least $1 million more. Now, if you have two at $500,000, yeah, we can do that, right? But that's
Okay.
kind of where it stops.
Okay. Got it. Thinking about this. Okay. So, is there any other kind of, so just to circle back regarding the kind of statements about IRAs. So you can get in some challenges if you have like a 401k that's going to invest in the deal that you're the GP on. Like if you're an LP investor, you can't have your 401k invest. Some would even make the argument that you shouldn't invest alongside your 401k as an LP investor, but you certainly shouldn't invest your 401k money into LP interest in a deal that you're the GP on, because there's the self-dealing thing.
Right.
Would that be a part of this at all?
Zero. That's the beauty of ours. We're more flexible. There's no minimum required distributions. There's no problem, doing the LLC, LP. You can either go from the trust directly into an LP passive position, or we would form that LLC in partnership as if you're a general partner or you're running that fund, right? So
Okay.
it's a mix, and there's no problems there. We're not a retirement account. We're just an installment sale, right? So we're not tied to a lot of that extra 401k, IRA, regulations, if that makes sense.
Got it. And just to circle back on the fees, you mentioned it's close to a 1.5% upfront fee.
one time, and then an ongoing
One
one and a
time.
half. So let's say it's $1 million gross sales price. It's
Right.
15,000 one time. That covers lifetime audit defense. Those are my business partners, the tax attorneys.
Okay.
Right? Perfect track record, 25-year track record, thousands of closes, billions under management. Faced the IRS about 15 times. It's never all no change audits. It's been never been on a promoter list, never been on like a dirty dozen list they call it. And also, they provide lifetime audit defense, state or federal. They will cover no additional charge should you be audited. So that's the tax attorney part. Second part would be myself and my business partner for financial advisor. It's about 1.5% of the AUM. So if it's $1 million, it hits the account. It's about 15,000 on a recurring basis. Some of it charged up front, some of it's charged as the funds go. No matter how and where the funds are invested, whether it be in your own GP deal or a passive real estate deal, or all of it in the stock market, right? It's about 1.5%. But the goal net of the recurring fees at the end of 10 years is to get you 8% compounding, which is pretty good, right? It's pretty good.
I mean, yeah, but that's really the real goal is to compound the assets in the trust.
Yes, in two ways, right? So the first way is to pay you the 8, but the better way is to take that LLC, and this is where you're really going to like this, Hunter, and people miss this piece here, okay? So remember, when we're in IRC 453, Deferred Sales Trust, we don't have any timing restrictions, right? So we have none of the 1031 requirements of equal or greater value or timing restrictions. So we can put it into this trust and sit on the sidelines and wait for the right opportunity. Now, if you are an active GP, right, in a deal, you can partner with your trust, and we form that LLC, and we can give you up to 98% of the upside of that deal. So let's walk through that. So you close a $10 million deal, you would have paid $4 million of tax. You put $10 million into the trust, $8 million the next day goes to an LLC, and you buy, let's say, a $20 million apartment complex. Okay. Now you, Hunter, put 0 into that LLC. The trust put up all of the down payment as a silent partner. Okay. But you, Hunter, have 80% ownership of the LLC day one.
Cool.
With an option to carve out up to 98% upside of that $20 million deal. So let's say you add value, it turns into $30 million, you sell it 5 years later. You can carve out the upside from the trust and get 98% of the upside. So the end result would be Hunter put 0 in, but got 98% of the upside, right, from 20 to 30 million after he paid back the preferred return on the 8 million, which the trust put in, right? And the trust would get the 2% upside. So that's like the secret sauce. And once you actually get that and like get the boxes and go through the options agreements and look at that, that changes the game forever, because not only did you hopefully buy that property at 20 instead of buying it, let's say at 24 in a 1031 exchange, a year prior, but second, you have a brand new depreciation schedule, right? One of the number one reasons to own investment real estate is for the depreciation offset the cash flow. But guess what? In a 1031 exchange, your depreciation schedule travels. The second part is after 27 and a half years, your depreciation depletes to 0, right? So the intent is to get a brand new depreciation schedule. The challenge with 1031 is the blockbuster way of doing it. You have old depreciation schedule. The Netflix Deferred Sales Trust, we sell, we get a brand new one, then we rinse, wash, repeat. So you catch all that, Hunter, or you want me to repeat?
No, that's all great. I mean, I certainly caught it. If you're not super familiar with the language, maybe it's a good time to go back and re-listen, but that's all really good. So, when is the timeline for this? So like, let's say that you have someone that's trying to liquidate something in 30 days. Is that like too late? How does it look on your end?
So it depends on the A, the sophistication of the client, B, where the contract has contingencies removed or not. So let's first start with non-investment property, okay, non-1031 qualified property. So that would be cryptocurrency, that would be a business sale, that would be a primary home, artwork, collectibles, right? We need to have the trust actually formed and actually inserted into the purchase and sale agreement via an addendum. Basically, you're assigning your rights to the trust. You have an option to do that. You're not obligated. So if someone calls me today and says 30 days, I'm closing, I'm kind of considering it. Hey, no cost, no obligation. Let's set up the trust. Let's get it formed. It only does business with you. Let's put it into the contract. Then you have another, let's say 29 days to do your due diligence. Then you can exercise that option to move the funds into the trust. If for some reason you don't use the trust or your deal doesn't close, you don't owe anyone anything. So we take all that pressure off. However, if you call us the day after all contingencies have been removed, we're going to say, I'm so sorry. Like it's too late. We cannot use the deferred sales trust. Why? It's basically the part of what's called constructive receipt, that you basically have constructively received those funds, even though it hasn't technically closed. So that's why we can't do it. Now let's go back to the 1031 way. So the deferred sales trust can save a failed 1031 exchange. In fact, we've saved 3 deals in the last 40 days out of 7 deals that we closed, okay? How we do that is we set up the trust once the funds are at the qualified intermediary, and instead of sending it to their personal account, we send the funds to the trust. So we're maintaining non-actual or constructive receipt, but that only works for investment property. Now, some clients want to close the trust immediately at close on an investment property, which we can do right there, or basically day 46 or basically day 181. Now, you want to, not every qualified intermediary works and allows or knows about this. So we do have our preferred strategic alliances that we want to make sure you're in touch with so you know, and it's very seamless. But hopefully that answers the question, Hunter, on that.
Yeah, it does 100%. So can I just do a quick summary? Because I have to run in just a second.
Sure.
This is exactly what I was hoping for, by the way. So I appreciate it. Let's you have $1 million of gains. We say, okay, look, let's set up this trust. We can do it pretty quickly. It'll allow you to transfer the assets to the trust. At that point, you have a trustee, which everything has to be accepted by both the trustee and the person. I'm assuming you have some security in place regarding the trustee. He can and can't move things in certain manners.
100%. We have a bank account. Actually, it's called a deposit account control agreement. It's a bank in Southern California, $16 billion. I can't push the red button. I'm the trustee. You physically have to sign for it. I have to sign for it. They have to review it. And then the bank pushes the button to go to the next investment. So it's all protected. Yeah.
Very cool. Okay. That's actually a really important point because I know that there's probably a lot of people listening to this and are looking for the scam because they're trying to figure out why they haven't done this already, basically. Right. And whether, so that's a really important one. It's similar in the hedge fund space to a managed account where the person can go in and make trades, for example. It's a metaphor, so it's not exact, but people can make trades, but they can't send money in and out, right? They can only move money. Yeah.
I can't log in and push the button, right? I can only send you a paper to sign. And a lot of times the bank will even email you to confirm or call you to find out, hey, 4 million's going out, Hunter. Did you sign? Yeah, that's my signature. And they match it up, physical signature, right? And then they send the funds.
Okay. Yeah. So you got the $1 million of gains, you transfer to the trust. You can then sell the assets and you have to, at that point, you can have cash in this trust. You would then take a minimum of 20% and put it into liquid assets, as in, top tier blue chip type of companies, S&P 500, et cetera. The 80% that's remaining, you're basically allowed to invest it however you see fit. And obviously the trustee to some degree has some kind of input in either, the transactions, et cetera, but you can invest in anything, including deals in which you're general partner.
Correct. Yes.
The 8%, is that a required distribution to you, that 8%?
No, you can delay distribution. Like I have a client, we just did a $2.6 million deal in Alabama, and he's in his 40s and he's making like $1 million a year in his income. So he doesn't want or need the income. So we can do income tax deferral. He's delaying payments from the trust. Now the 8% is compounding and building because that's what's owed to him, but he's not having to take distributions to him until a future date.
Right. So look, if you're going to go through all of this, I mean, that's what I would suggest you do. This is like golden money now. It's basically you're in the promised land of what everyone wants to do. All the nonsense people go through for dealing with self-directed retirement accounts, you've basically created one. So you just don't take those distributions. If you're in a position where you have $5 million of Ethereum, for example, figure out a way to make enough money so you don't have to take the money out of the whatever. Yeah. Okay. Last structural question, and I really do have to run. This has been very, very helpful, by the way.
We can do round 2 next week too, by the way, bro.
This is the thing.
On this. Yeah.
I also like working with you because I have to always listen to my podcast at like 3x speed, and we don't have to do that on this one. So I'm sure there's people listening. So one other question though, let's say I have a syndication where I'm a GP owner of a syndication and there's 50 investors. In a 1031, we have to go through and everybody has to agree, it has to be unanimous, et cetera. Can you do that as a GP owner of a syndication? How does it look?
Yep, absolutely. We call that seamless partnership separation. Remember, the 1031 exchange, the whole entity must move. Typically, you get all 100% approval, which is a mess, right? And the Deferred Sales Trust, we just closed 2 deals for 2 GPs, Dave and Jordan. You can hear their story. They sold a $20 million asset in Las Vegas, and they had a ton of LPs. The LPs just took their money back the normally way, and they paid their tax. But each of their GP positions, Dave and Jordan's, went into their own individual Deferred Sales Trust accounts. Then they did it for a second deal, $16 million deal in Phoenix. And those funds rolled into the same trust account. And this is the cool part. They bought a deal in Dallas, and part of the funds went into that active GP deal. So yes, 100% you can do that. It's one of the best kept secrets of the Deferred Sales Trust.
Okay. And the 50 investors, they have an opportunity to participate in this, or is it
Yes, if their deal was $1 million or more. A lot of the investors with a lot of GPs we work with are 50, 100, 200, right? And there's not enough gain, right? So, but yes, if they had that, then they could do their own LP one too.
Dude, you killed it. You answered all my questions. I appreciate it. We're going to be in touch real soon, man.
Thank you. And for our listeners, go to Capital Gains Tax Solutions podcast or capitalgainstaxsolutions.com. You can also search on iTunes for the and YouTube for the podcast. And please rate, review, subscribe. We appreciate everybody. Thanks, everybody. Bye now.